In March of 2020, while you were locked in your house worried about a virus and wondering how you'd pay rent, the Federal Reserve created $9 trillion out of thin air and gave it to Wall Street, not through congressional appropriation or democratic process, but through emergency powers that allow the Fed to create unlimited money with no oversight, and you got a one-time payment of $1,200 that took months to arrive, while JP Morgan Chase got access to trillions in overnight lending at 0% interest. Goldman Sachs bought corporate bonds with newly created money. BlackRock was hired to manage Fed programs and used that position to profit. And the wealthiest 10% who own 89% of all stocks watched their portfolios soar as printed money inflated asset prices. But if you're a working person whose savings earn nothing in a bank account while inflation destroyed your purchasing power, you got $1,200 and were told to be grateful. And if this makes you angry, it should, because what happened in 2020 was the largest upward wealth transfer in human history, and it happened in plain sight while everyone was distracted by a pandemic, and nobody went to prison, nobody was held accountable, and the people who engineered it are planning to do it again. This is the story of how the Federal Reserve created $9 trillion in new money in less than 2 years, how that money went overwhelmingly to banks and corporations and asset owners, while ordinary Americans got a few stimulus checks totaling less than $3,000 per person. But more importantly, this is about understanding how money creation works, who benefits from it, why inflation isn't accidental but rather a deliberate policy choice that transfers wealth from savers to debtors and from workers to asset owners, and why the next time they do this, and there will be a next time, you need to understand the mechanism so you can position yourself on the winning side instead of the losing side. Because right now you're on the losing side and you don't even know the game is being played. This is the story of the largest wealth transfer in human history. $9 trillion created from nothing and injected into the financial system in less than 2 years, dwarfing even the response to the 2008 crisis. But while ordinary Americans received one-time payments of $1,200 that barely covered a month of expenses, banks and corporations and asset owners received trillions in direct support, loan facilities, asset purchases, and liquidity injections that inflated asset prices and made the wealthy dramatically wealthier while everyone else struggled through lockdowns and job losses. And if you think the stimulus check you got was the government helping you, you need to understand that it was a tiny fraction of the money created, a pittance designed to pacify you while trillions flowed to financial institutions and corporations. And the inflation you're experiencing now, the reason groceries cost 50% more than they did in 2019, that's the hidden tax you're paying for the $9 trillion the Fed created to bail out the financial system while giving you $1,200 and telling you to be grateful. This is the story of the greatest wealth transfer in human history, executed in plain sight during the chaos of a pandemic, sold to the public as emergency relief while actually functioning as the largest bailout ever, dwarfing 2008 by multiples. But what makes this different from previous crises is the mechanism. In 2008, the Fed bailed out banks through loans and asset purchases that were at least somewhat visible and tracked. But in 2020, they created money on a scale that was unprecedented in human history, $9 trillion conjured into existence through Federal Reserve operations that most people don't understand and that very few journalists even attempted to explain. And this money didn't go to the people suffering from lockdowns and job losses and business closures. It went almost entirely to banks and corporations and asset holders, while ordinary Americans got a one-time payment of $1,200 and were told to be grateful. This is the story of the largest wealth transfer in human history, executed in plain sight under the cover of a pandemic emergency, where the Federal Reserve created more money in 2 years than had been created in the previous century. And almost all of it went to the already wealthy, while working people got a pittance and were told to be grateful. But more importantly, this is about understanding that what happened in 2020 wasn't emergency response to an unprecedented crisis. It was the acceleration of a pattern that's been running for decades, where every crisis becomes an excuse to transfer more wealth from the public to financial institutions. And COVID provided the perfect cover because who could argue against emergency measures during a pandemic, except the emergency measures weren't designed to help you. They were designed to protect bank balance sheets and corporate profits while giving you just enough to prevent riots. This is the story of the largest wealth transfer in human history, where the Federal Reserve created $9 trillion in less than 2 years and channeled almost all of it to banks, corporations, and asset holders, while giving ordinary Americans a one-time payment of $1,200. But more importantly, this is about understanding how money creation works, who benefits from it, and why inflation is not a natural force but a policy choice that transfers wealth from workers to asset owners. And if you think the government was trying to help you during COVID, you need to understand that the stimulus check was a distraction, a pittance thrown to the public while trillions flowed to financial institutions, and the inflation you're experiencing now, the rising costs that have destroyed your purchasing power, that's not a consequence of the pandemic, it's a consequence of the money printing that happened during the pandemic. And you paid for that money printing twice, once when they created it for the banks, and again through inflation that destroyed your savings. This is the story of the greatest wealth transfer in American history, executed in months under cover of a pandemic emergency where the Federal Reserve created $9 trillion in new money, gave most of it to banks and large corporations through asset purchases and lending programs, while ordinary Americans received one-time payments of $1,200 and were told to be grateful. But more importantly, this is about understanding how monetary policy works as a wealth transfer mechanism from the bottom to the top, how inflation is a hidden tax that falls hardest on people who can't protect themselves, and how the next crisis will use the same playbook because it worked perfectly in 2020. The banks got richer, the wealthy got richer, and everyone else got inflation and a $1,200 check that was supposed to compensate for the destruction of the economy. This is the story of the greatest wealth transfer in human history, executed in a matter of months under the cover of a public health emergency, where the Federal Reserve created $9 trillion out of nothing and gave most of it to financial institutions and large corporations, while ordinary Americans got one-time payments of $1,200 and were told to be grateful. But more importantly, this is about understanding how money creation works, who benefits from it, and why the inflation you're experiencing now is the direct result of decisions made in March and April of 2020, when the Fed printed more money in 2 months than had been printed in the previous century. And if you think that money was created to help you through the pandemic, you fundamentally misunderstand who the financial system serves. This is the story of the largest wealth transfer in human history, how $9 trillion was created out of nothing and given primarily to financial institutions and corporations, while working people got one-time checks of $1,200. But, more importantly, this is about understanding how monetary policy works in practice versus theory, because the Federal Reserve will tell you they create money to stabilize the economy and prevent depression. And that's technically true but fundamentally misleading, because the mechanism of money creation always benefits those closest to the money printer, which means banks and large corporations and wealthy individuals who own financial assets, while the costs of inflation and currency debasement fall on wage earners and savers. And this pattern has repeated throughout history and will repeat again. And understanding it is the only way to position yourself on the winning side rather than the losing side. This is the story of how in March of 2020, as the COVID pandemic was beginning and the economy was shutting down, the Federal Reserve created more new money in 3 months than it had created in the entire previous century, $9 trillion conjured into existence through digital entries. And while the government sent most Americans a one-time payment of $1,200 and told them to stay home and be grateful, that $9 trillion went almost entirely to banks, corporations, and financial markets, propping up asset prices, preventing bankruptcies of large firms, and ensuring that the wealthy not only didn't suffer losses, but actually got richer during a pandemic that destroyed small businesses and cost millions of jobs. And if you got your stimulus check and thought the government was helping ordinary people, you need to understand that you received crumbs while Wall Street got a feast, and the bill for that feast will be paid through inflation that destroys your purchasing power for decades to come. This is the story of the largest wealth transfer in human history, over $9 trillion created by the Federal Reserve in less than 2 years, money that didn't exist on Sunday and was conjured into existence on Monday through digital entries in computer systems, and this money didn't go to families struggling through lockdowns or small businesses forced to close or workers who lost jobs. The vast majority went to large corporations, banks, and asset holders who used it to inflate stock prices and real estate values, while ordinary Americans got a $1,200 stimulus check and were told to be grateful. And if you think this is how emergency monetary policy is supposed to work, you need to understand that you watched the largest upward wealth transfer in American history happen in real time, while the media called it stimulus, and the public debated whether $1,200 was enough. This is the story of how the Federal Reserve created $9 trillion in 18 months, more than twice what they created in the entire 6 years after 2008, and how that money flowed primarily to asset holders rather than workers, to Wall Street rather than Main Street, to the already wealthy rather than those most harmed by the pandemic. But more importantly, this is about understanding that what happened in 2020 wasn't emergency response, it was opportunistic wealth transfer using crisis as cover, and the playbook that worked so well will be used again in the next crisis, which means if you don't understand the mechanism, you'll be victimized by it repeatedly, watching your purchasing power erode while being told the system is trying to help you. The mechanics of how the Federal Reserve creates money are important because most people don't understand them, and this ignorance allows the system to operate without accountability. When people hear that the Fed printed $9 trillion, they imagine printing presses running overtime, churning out physical bills. But that's not how it works. The Fed creates money electronically by making entries in accounts. They buy assets from banks and credit the bank's accounts with money that didn't exist before. And this new money enters the financial system where banks can lend it or invest it, and the first recipients of this money benefit enormously because they get to spend it before prices adjust, before inflation kicks in, before the currency devalues, and by the time the inflation reaches ordinary people through higher prices for food and rent and healthcare, the wealth transfer is complete. In March of 2020, when the pandemic hit and lockdowns began, the Federal Reserve announced unlimited quantitative easing. That was the actual term they used, unlimited, meaning they would buy as many assets as necessary to support markets. And what this meant in practice was that they bought treasury bonds from banks giving banks cash, and they bought mortgage-backed securities giving banks more cash, and they established lending facilities where they would lend to corporations at favorable rates, and they backstopped money market funds and municipal bonds and corporate bonds, and the total amount of assets they purchased in 2020 alone was approximately $4 trillion, and in 2021 they purchased another $3 trillion, and this didn't include the emergency lending facilities, which were separate programs that created additional trillions in liquidity. Now you might ask why this was necessary, why the Fed needed to create trillions of dollars when the problem was a pandemic, not a financial crisis, and the official explanation was that they needed to prevent markets from seizing up, to ensure credit kept flowing, to prevent a cascade of defaults that would worsen the economic damage from lockdowns. But here's what actually happened. When the pandemic hit and uncertainty spiked, wealthy investors started selling stocks and bonds to raise cash. This selling was driving prices down rapidly, and if you're a billionaire watching your portfolio lose 20 or 30% in a few weeks, you want someone to step in and stop the decline, and the Federal Reserve obliged. They announced they would buy unlimited quantities of assets, which meant investors knew there was a buyer of last resort, and this put a floor under asset prices. And once that floor was established, investors stopped selling and started buying again, and prices recovered and then exceeded pre-pandemic levels within months. Let me show you specifically where the $9 trillion went by tracing the money flows. The Federal Reserve bought approximately $4.5 trillion in treasury bonds. When they buy these bonds, they credit the accounts of the banks selling them, so banks received $4.5 trillion in cash. And what did banks do with this cash? Some of it they lent to corporations at low rates. Some they invested in stocks and real estate. Some they used to trade and speculate, but they didn't lend it to small businesses struggling through lockdowns. Small business lending actually declined during 2020, despite the flood of Fed money, because lending to small businesses is risky and complicated, whereas investing in stocks propped up by the Fed is easy and profitable. The Fed also bought approximately $2.5 trillion in mortgage-backed securities. These are bonds backed by pools of home mortgages. And when the Fed buys these securities, They push up prices, which pushes down mortgage rates, and lower mortgage rates allowed people to refinance and saved homeowners money. But the bigger effect was on home prices, because lower rates mean people can afford to borrow more money, which means they can bid higher prices for homes. And this is exactly what happened. Home prices increased 30 to 40% in many markets between 2020 and 2022. And if you already owned a home, your wealth increased dramatically. You might have gained $100,000 or $200,000 in paper wealth from your home appreciating, but if you were trying to buy a home for the first time, you are now priced out of the market. And this is a wealth transfer from young workers to older homeowners facilitated by Fed policy. If you're starting to feel like the Fed works for asset holders, not workers, for the wealthy, not the struggling, you're understanding how monetary policy actually functions versus how it's described in economics textbooks. And if you want to learn more about these mechanisms and how to position yourself to benefit rather than be victimized by them, you need to subscribe to this channel immediately, because we document how the financial system really works, not how it pretends to work. And understanding this is the difference between watching your purchasing power erode and actually preserving wealth. So click that subscribe button and turn on notifications, because what comes next in this story is going to show you exactly who benefited from the $9 trillion and how much they made while you got $1,200. The stock market tells the story most clearly. In March 2020, when lockdowns began, the S&P 500 fell from 3,300 to 2,200, a drop of about 33%, and wealthy investors were panicking because their portfolios were collapsing. But then the Fed announced unlimited QE and emergency lending facilities, and the market immediately reversed. By August, it had recovered all losses and was making new highs, and by December 2021, it had nearly doubled from the March 2020 lows. And who benefited from this? The richest 10% of Americans own about 90% of all stocks, so when the stock market doubles, they capture almost all of those gains. And the amount of wealth created through stock appreciation between March 2020 and December 2021 was approximately $14 trillion, and almost all of it went to people who were already wealthy. Meanwhile, workers faced a very different reality. Unemployment hit 14.7% in April 2020. 50 million people filed for unemployment insurance, and while some of this was temporary as businesses reopened, many jobs never came back, and the jobs that did return often paid less than before. And through all of this, workers received $1,200 from the stimulus check, then $600 from a second round, then $1,400 from a third round, for a total of $3,200 over 18 months. And this was supposed to be emergency support during the worst economic shock in modern history. $3,200, while the Fed created $9 trillion for asset markets. The comparison is obscene. The Federal Reserve created approximately $28,000 per American in new money during 2020 and 2021, but ordinary Americans received $3,200 in direct payments, which means about 90% of the newly created money went somewhere else. It went to banks and corporations and bondholders and asset owners, and they used it to bid up prices of stocks and homes and real estate, and those price increases created wealth for people who already owned assets while making everything more expensive for people who didn't, and this is how Fed policy always works. They claim to be helping the economy, but what they're really doing is transferring wealth from people who work for money to people whose money works for them. The corporate bond market shows another dimension of this transfer. Before the pandemic, corporations borrowed money by issuing bonds, and bond buyers would assess the risk and demand interest rates proportional to that risk. But when the Fed announced they would buy corporate bonds, including junk-rated bonds, they eliminated risk for bond buyers, because even if a company was likely to default, the Fed might buy those bonds and pay full price, and this created a massive subsidy for corporations. They could borrow at artificially low rates that didn't reflect actual risk, and they used this cheap money not to invest in productive capacity or hire workers, but to buy back their own stock, which increased stock prices, which enriched executives who were paid in stock options, and the amount of corporate debt outstanding increased by trillions during 2020, while corporations paid out hundreds of billions in buybacks and dividends. Let me give you a specific example so you understand the mechanism. A company like Boeing, which was struggling before the pandemic and had massive losses during it, issued bonds to raise cash, and normally investors would be wary of lending to a company losing billions and demand high interest rates to compensate for risk. But because the Fed announced they would buy corporate bonds, investors knew there was a backstop. They could buy Boeing bonds at reasonable rates, and if Boeing struggled, they could sell those bonds to the Fed, and this eliminated the discipline that markets are supposed to impose. Companies that made bad decisions and faced financial trouble got bailed out through cheap credit provided by the Fed, and shareholders and executives kept wealth that should have been wiped out through bankruptcy. What would you have done if you were a worker in March 2020, laid off because your employer closed, facing rent and food costs with no income, and you heard the government was doing massive stimulus? Would you have expected that stimulus to come to you directly, that the $9 trillion being created would mostly go to support workers and families? Or would you have understood that in America, emergency policy always benefits asset holders first, and workers get whatever is left over, and if you believed the former, you were disappointed, and if you understood the latter, you weren't surprised, but you were still victimized? The inflation that followed was inevitable and predictable when you create $9 trillion and most of it flows into assets rather than being evenly distributed. You get asset price inflation first, stocks and homes and collectibles all increased dramatically, and then you get consumer price inflation as the money filters through the economy, and by 2021 and 2022 inflation hit 40-year highs. Food prices increased 25%, energy prices doubled, rent increased 30% in many cities, and workers saw their real wages decline because even though nominal wages rose slightly, prices rose faster. And this inflation was the final stage of the wealth transfer, because inflation is a tax on people who hold cash and fixed incomes, which means workers and retirees and savers all lost purchasing power, while asset holders whose wealth was in stocks and real estate saw their assets appreciate faster than inflation. The Federal Reserve will tell you they didn't intend this outcome, that they were trying to prevent economic collapse, that the distribution of benefits wasn't their fault, but rather a feature of how monetary transmission works. And this excuse is technically true but fundamentally dishonest, because the Fed has studied monetary policy for decades. They understand perfectly well that when they inject money through asset purchases, it benefits asset holders. They could have designed policies that distributed money more evenly. They could have supported direct payments to households. They could have bought different assets or used different mechanisms, but they chose the approach that benefits banks and investors because that's who they serve, and claiming ignorance about the distributional effects is just refusing to take responsibility for choices they made deliberately. The comparison to what other countries did during the pandemic reveals how inadequate American policy was for ordinary people. Many European countries paid workers 70 to 90% of their salaries throughout lockdowns. They kept people on payrolls even when businesses were closed. They provided robust unemployment insurance and rent support. And while those countries also did quantitative easing, they coupled it with much stronger support for workers and families. But America gave $1,200 and told people to pull themselves up by their bootstraps while handing trillions to corporations and banks. And this choice wasn't inevitable. It was a political decision that reflected who has power and whose interests matter. The question you need to ask yourself is why this keeps happening. Why every crisis results in money flowing upward from workers to capital owners, from the struggling to the comfortable, from Main Street to Wall Street. And the answer is that monetary and fiscal policy in America are controlled by and designed for the benefit of asset holders. And until that changes, the pattern will repeat. The next crisis, whenever it comes, will be met with unlimited support for banks and corporations and asset prices, while workers get token payments and are told to be grateful. And understanding this pattern is the first step toward either positioning yourself to benefit from it by owning assets or working to change the system so it serves different interests. If this video has made you angry that you got $1,200 while banks got trillions, if you're looking at the stock market boom during a pandemic differently, if you're starting to realize that inflation was not an accident, but the predictable result of policy choices that enrich the wealthy at the expense of workers, then you need to watch our next episode, where we're going to show you exactly what the Fed is planning for the next crisis, why they're building central bank digital currencies that will give them even more control over money, and how the tools they're developing will make the 2020 wealth transfer look small. By comparison, subscribe now and turn on notifications, because understanding these mechanisms before they're deployed is your only chance to protect yourself. And share this video with anyone who still thinks the Fed works for ordinary Americans, because the more people who understand how the system actually operates, the harder it becomes for them to keep doing it.